TheoTrade. This is Don Kaufman. March 4th, 2022, 12 minutes to go. In this trading week, has the onslaught of volatility only just begun? We're going to answer that and much more here on this weekend update. First and foremost, let's give you a brief review of some of the price action in this week of trade. Presently, and again, with just about 12 minutes to go to the cash close, SPOOs are off some 54 handles, seeing some sell side activity. We are going to talk extensively about, well, what I term a volatility situation that has simply come to a head. I'll explain that in more detail here momentarily. First and foremost, it is imperative to understand that the S&Ps are effectively inside of what I term a volatility box. You know, to give you the most effective and most efficient update possible in markets, take a look at the S&P futures along with me, and I'm going to switch to a 30-day 1-hour chart. Now, listen, I am not one for market technicals, and there's no technicals being implied in what I'm displaying here on this S&P chart. I'm going to go ahead and close up this left side bar and just give you a little detail on what I term, okay, the volatility box, aka the hurt locker. This is where people just get ground apart. One of the aspects you have to kind of recognize, okay, inside of the S&Ps, started channeling back and forth in, again, what I term a volatility box all the way back in the January timeframe. In that January timeframe, we opened up, again, a tremendous amount of open interest in the option markets specific to the SPX, the spiders. I mean, listen, these are the marketplaces, well, that drive the S&Ps. Lo and behold, because heavy trade, okay, persisted and heavy open interest persisted, what that is in fact done is drive more volume, more open interest, and we're almost like trapped, again, inside of this volatility box. However, the situation is in fact kind of coming to a head. You know, something I mentioned in the Wednesday, okay, evening video, and I took a lot of hits on email about this, as I said, listen, you do not look at this as a rally. Okay, you got to look at it as nothing more than a volatility box. We're just going to literally ping back and forth until ultimately, okay, we smash higher or lower through it. Now, I am absolutely going to give you, okay, my opinion as to smashing through it to the upside or to the downside. And I got to tell you, right now, it does not look pretty. Hence, I'm going to be a little bit bearish at this point in time. But people, it's not over yet. But that volatility box really sums up almost the entire trading week. All you're looking at right now, okay, is hedging activity and us getting pinged back and forth. All right, markets opened on a, on a Sunday afternoon. They dropped precipitously. We rallied back. We sold off. We rallied back. We sold back off. We rallied back, and we are selling back off into today's cash close. But with all due respect, right now the S&Ps are down 1%. They're faring extraordinarily well. They really are. The other aspect, I think that kind of resonates with me. And again, I'm not into technicals. I just don't think that technicals are going to help you with the geopolitical hotbed of risk right in front of you, right? But one thing that really does resonate with me is that there's not, if you will, like a catastrophic amount of volume inside of the S&P futures. And what that says to me is that there's just not a huge amount, okay, of, people willing to commit to trade. All we have right now is just hedging activity, and it's not that considerable. I mean, how many days have you seen S&Ps down by like 1%? And we're barely doing over like 1.5 million contracts. Evidently, this is pretty far from, if you would, capitulation. You see any degree of capitulation? The last time maybe we saw a glimpse of capitulation, you got to look for some wild down days where, you're doing 3.5, 4 million contracts, right? Here's again, and another kind of big reactionary low. We did some big volume, but we're just kind of slipping off into the sunset here. There's no size, people. Without size, okay, you're not getting the commitment. you're not seeing any type of capitulation in the trade. You're just seeing, again, the listless nature of a marketplace that is almost like, if you will, in denial at this point. Now, to give you a little bit of a further update, okay, in terms of price action, don't worry, we're going to look at volatility, we're going to look at bonds. But from a sector point of view, what was the sector that we're bearish on? Okay, unequivocally, it has been none other than the financials. All we've been looking at lately are financials, big tech, financials, big tech, maybe a little energy in there. Why? Because these are the sectors right now, okay, that are driving the S&P 500. And if you take a look at financials, this is where we've been, again, the most bearish. Let's actually apply what we term auto expected moves. Auto expected moves, if you're unfamiliar with it, all it's really doing is using the options marketplace to kind of handicap how far this underlying is supposed to move. And this underlying question here is the XLF. It's the financials ETF, right? So we're supposed to move, up here just above 40 or down here to like 38. Where are we right now? Swing and a miss. We're down at like the 37 handle. All right. We got smashed in terms of the financials this week. Consequently, at the exact same time, let us take a look at the QQQ. The Nasdaq is also, it's hanging on to the bottom edge of the expected move. It's just right there. I look at this and I think to myself, okay, where then are the S&Ps? Like, where are the S&Ps? And I'm pretty shocked to find the S&Ps, they have not smashed the lower edge of the expected move. How is that even possible? How is it plausible that the Nasdaq, okay, gets crushed? Okay, it's down at the lower edge of the expected move. The financials, they're 2 times, okay, the expected move. 5 minutes left in the trading day. How is it possible, though, that we still hung on in the S&Ps? The S&Ps, here we are. Again, 5 minutes go to the cash close. We're down on the week, but mildly so. A lot of that answer can be found in none other than, okay, an absolutely immense breakout, specifically inside of energy. And to talk about an immense breakout, the breakout in the energy sector, okay, is larger and more significant than the breakdown in the financials. Okay, hence, yes, the S&Ps were lower because big tech is lower. Yes, the S&Ps are lower because financials were a massive drag. But the energy sector, which is a rather small sector, but you get a feel for how much influence it has because this was that phenomenal of a move. All right, with that, now, okay, let's start to discuss how these onslaught of volatility, maybe it's only just begun. For that, well, let's start to examine a few of the volatility indicators. And some of this is going to be a little bit disturbing to you. First and foremost, I'm going to go ahead and I'm going to bring up the VIX. Now, I am not, okay, a huge advocate of looking at VIX in terms of any technicals in any way, shape, or form. Just don't simply buy into any of that. The VIX is a calculation based on S&P 500 options, right? It's 30-day average options in the S&P 500. The VIX, to me, it's going up. All I want you to see, okay, in this particular context on this chart, okay, is one aspect and one aspect alone, and that is the VIX, okay, has been going up considerably. Well, the VIX has been solid in terms of hanging on to a bid. And really, like the last 2 weeks of trade, okay, it's pretty evident that VIX is bid. At the exact same time that the VIX has been bid, take a look at the SPX, right? What has the SPX and what's really transpired in the SPX over the last 2 weeks, okay? This is a week of trade. This is a week of trade, or it's a 4-day week of trade, then a 5-day week of trade. But what have we really done? And the answer is, well, it's the previous week where we started, where we, kind of ended here, where we started, where we ended. For the most part, what are we over the last 2 weeks? We are massively unchanged over the last 2 weeks inside of the SPX. But at the same time that we are unchanged in the S&Ps, well, what have the Qs done? Okay, and it's okay to look over at the QQQ. Well, maybe it's the Nasdaq that's causing some of the volatility. But lo and behold, the Nasdaq, it's maybe down mildly in the last 2 weeks of trade. It's got to be the Russell. Maybe it's the Russell in here. The Russell hasn't done anything really since like January. It's up, if anything, from like mid-January. So that's just not it. What you have, okay, is again, the VIX, it just keeps priming and priming and priming. When I say that the VIX is priming, right, that's what you kind of feel like. Situation is kind of coming to a head. Now you kind of understand. It doesn't matter if the VIX is closing down today. The market hasn't done anything. We're rallying right now, okay? But, okay, lo and behold, again, that situation is coming to a head, and it was already ramping up considerably prior to any of the geopolitical risk hitting the marketplace. In addition to it, take a quick glance with me here over at volatility, okay? And this is Volatility Futures. And the one thing that I really want you to like kind of try to soak in is that the Volatility Futures, what they really mean, right? In context of here's an April Volatility Future and it's trading at 30.30, right? And that's, again, it's APE. Okay, against the volatility future that's some 75 days out. And then we have this May, and that May is trading at, let's call it 29.30. How can risk be bigger right now in the next 47 days than it is out here 75 days? What they're actually implying is, okay, the world has a better chance of coming to an end in the next 47 days than it does 75 days. This is what we term, okay, volatility backwardation. Put on your big boy pants because this one's huge. In any time that we're in this volatility backwardation, it makes those S&P futures just downright squirrely. Now, I'm going to leave it at that because that's something I usually expound upon much more here at TheoTrade. And there is the closing bell. All right, SPOOs are going to finish down some 35 handles. Nasdaq off by 200. It's ugly. Any way you want to look at it. This backwardation inside of volatility, I'm just going to leave you with the feeling it's an uneasy feeling, not only to see a backwardation sustain this long. Clearly, there's a reason for it. It's geopolitical risk, right? Okay. But that this backwardation, as long as we're in it, destabilizes the S&P futures. Along with that, again, you have VIX. And the VIX, I mean, it just feels like it's ready to explode, erupt, if you will, to the upside. You can look back, all right, 3 years if you want. You just don't see this kind of price action. Most of the time, when risk hits the fan, VIX just rips and then it's over. This is different. It's very different, okay? VIX has quietly been bid in the backdrop. And I got to be frank with you, it doesn't feel warm and fuzzy to me. In addition to it, you know, I have tendency to look at a lot of different asset classes that I personally interpret is, you know, people talk about risk on, risk off. I mean, I'm looking at asset classes like volatility futures. I'm looking at asset classes like VIX, bonds, right? I don't necessarily think VIX is an asset class, but it's definitely a great fear indicator. But you look at the bond market right now. What are the bonds telling you? These are what I kind of call duck and cover asset classes. Who's buying bonds to this amount? I mean, they're up 2.5 points today. Bonds, they're trading Armageddon in the last 3 weeks of trade. Are you looking? Are you paying attention to what's going on? Right? The move that we're seeing, I don't care whether you look at TLT, you want to look at the 10-year, okay? Look at some of the moves, again, that have transpired inside of the 10-year. This, okay, this is disconcerting. This is the world saying, you know what, okay, forget inflation. I'll take 7.5% inflation. I'm scared of the S&Ps. I'm so scared of the S&Ps, I'm going to dump money in bonds. I'm scared of Europe. I'm going to dump money in bonds. Okay, at the same time that they're just throwing capital into the bond market, right? We're buying volatility as volatility is priming. Take a look at the dollar, okay? The dollar, what? It's become like the new VIX. I mean, the dollar, the whole world right now, people are worried about the dollar might not be the reserve currency of the world, really? Because where are you going to go right now? You're going to go into the euro? I don't think so. They're throwing capital into the dollar. And the craziest thing is as they're throwing capital into the dollar, okay, we're still seeing gold appreciate. Gold. So Gold, is this more of duck and cover, or is this more because of inflation? Yeah, I don't really care which our answer is. The answer is yes. Okay, yes, buy it. All right, commodities are going through the roof. Obviously, everybody in the talk of the town here, of course, is oil. And, at this point in time, I'm not sure I even want to expand a tremendous amount about oil. The backwardation in here is just downright scary. But what's even more intimidating is that you're seeing oil 7 days from now at almost a 100% implied volatility, which is, okay, with all due respect, that's outside of my trading arena. Like, I don't want to get in the ring, okay, with an 800-pound gorilla named oil at this point with a backwardation, okay, that's between $3 and $4. I'm sorry, okay. I know as a trader, this is where you lose all edge, okay, and all feel for a marketplace. That backwardation, again, when you're seeing 115 in APE, okay, and 111 in the back month like May, that's when I say, that's it. Out of the contest. So again, be aware. Commodity pricing right now, people are like, hey man, can you talk about wheat? What's to tell you? It's limit up like every single day. Corn ain't far behind, right? Commodity right now is insane, which clearly is not going to help some of the inflationary pressures that are obviously in markets. But what really is astounding on this front, and I think is most astounding, you're seeing commodities fly higher with strength in the dollar. If you think about a barrel of oil at $100 a barrel, if the dollar were to get cut in half tomorrow, oil should shoot to 200. But in this case, the dollar is strengthening and oil's still going up. The dollar is strengthening and gold is still going up. All the commodity prices. This is like, the double and triple whammy, if you will, of inflationary pressures at this moment in time. Last but not least, on this particular front, I'd be remiss not to bring up crypto. Okay? In crypto, the call on here for us, short term, we were extraordinarily bullish. And that had to do with sanctions. Okay? Why were we so bullish? Because I interpreted that Russia's probably going to try to circumnavigate sanctions using crypto. Crypto marketplace is probably not even large enough for them to get that much done, and people will figure that out. But initially, the knee-jerk reaction was extraordinarily bullish. Bullish we got. At this point, dire bearish. Absolutely dire bearish in here, as ultimately, like crypto, if anybody thinks they're going to circumnavigate sanctions at this point, come on. Every sovereignty right now is looking at it and saying they're watching crypto like a hawk. Any positive movement in here, the regulations are going to jump all over this. I mean, now it's an issue, people, of national security. So keep an eye specifically on crypto. Again, very, very bearish in the near term now on crypto. It got its bump, okay, with the onset of those sanctions. Back to broader markets here for just a moment. So we looked at VIX and backwardation, vol and backwardation, bonds ripping, dollar ripping, commodity pricing ripping, crypto. We are very, very bearish. Again, that volatility situation has come to a head, and it looks like volatility is just going to erupt upon this marketplace. Another thing I want to remind you, okay, in this next week of trade is that all good news should be actually implied as bad. So we have a really interesting situation. I was telling traders earlier in the day, and I said, hey, I'm kind of nervous to want to go home long any stock. And by the way, I don't really have any long positions in my account. I don't mind showing you. Okay, P&L. Okay, I'm no holds barred here. I will show you everything, every account. Okay, I'm just not really long markets at this point in time. I'm selling a lot of options premium because volatility is a rocking, right? Nevertheless, I'm not really comfortable being long. And somebody said, hey, what happens if there's like a ceasefire over the weekend? And I go, yeah, but couldn't you interpret a ceasefire as it's great news? It's phenomenal news. Don't get me wrong. Could also be implied as very, very bad, because at that point, you're left with commodity prices that are soaring. Inflation's going to take center stage again. And once again, inflation is completely out of control at this point in time. So if the geopolitical risk comes to a sudden halt, Fed is going to go hog wild in raising interest rates. Okay. Imagine that for a second. all good news being implied and twisted into bad. It's the inverse Goldilocks. Recall, good is so very, very bad. Next, CPI is coming. This is something that's got to be on your radar screen. Why is it going to be on your radar screen? I don't know. Okay. CPI previous was supposed to come in at 7.5%. My take, CPI is going to come in hot, very, very hot, right? So if CPI comes in hot, the market's going to get another inflationary scare. Later during this course of this coming week, I'm actually likely to short bonds. So at present time, I'm ever so slightly long bonds. I'm going to give it a few days and I'm actually going to step in and I'm going to short bonds, thinking bonds are going to go back down. Why would bonds go back down? Take a look at interest rates, right? TNX, the interest rates have actually gone down considerably. So this again has a lot to do with some of the geopolitical risk. If their geopolitical tensions, okay, were to basically abate, this is going to go skyrocketing. So if this goes higher, bonds are going to go lower. Remember, there's an inverse relationship over there. Nevertheless, if CPI comes in hot, yeah, the interest rates are going to go up as well. Any way you look at this, I think that interest rates are probably due to rally back. So if you are in a bond position, I'm going to consider a short bond position as the week comes in here. Again, geopolitical risk, and I just wanted to remind you, geopolitical risk, okay, could be bearish and bearish. Horrific things are going on right now. If the geopolitical risk, persists, it's obviously going to keep pressure in the markets. But at the same time, if the geopolitical risk subsides, it could very well be bearish for the markets because, again, interest rates are going to come back into play in very, very big style. Last but definitely not least, I know this has been such a wonderful update here. It's hard at this point, to look at markets anything other than looking at it for what it is. And what it is right now is a volatility cluster. It's a geopolitical hotbed where ultimately every single night we're looking at S&P futures are like, holy crap, what's going on right now? I mean, I got to tell you, this week, how many times did I wake up in the middle of the night? I'm like, I got to look at futures. I got to look at futures. That's where we're at right now. All right. It's why I call it the hurt locker. I mean, the hurt locker is just like, holy crap, we're higher. Oh, we're going to be lower. Okay. You got to look at that. Major levels in the S&Ps, 4211. You cross through 4211, there is going to be fireworks. And at this point, I'm going to just throw this out here. If we cross through 4211, we're not coming back, for a long time. Cross through 4211 at this point, it's going to be rather dire. Stick a fork in us. I'll see you under 4,000 inside of the S&Ps. Be very, very careful in this next week of trade because, again, the volatility situation is clearly coming to a head. To further that, we are going to cruise to the SPX, the mother of all products. The SPX finishes the week mildly lower. We had a big boy expected move of $126 this past week of trade. What's this next week looking like? Now, just to categorize this and make sure everybody understands, next week, which Friday is March 11th, this is not completely settled yet, right? The market in the SPX does not close for another 4 minutes. We are looking right now at about $146 of risk. So hang with me on this thought. Last week, we saw $126 of risk. This coming week, right? It's exploding up. We're at 146. Understand that is a very substantial increase on a percentage basis. To go from $126 of expected move and then jump to like 146. Why is it such a big move? Why do I care? We didn't crack the upside. We didn't crack the downside. We saw some vicious moves, but we didn't crack either side of the expected move. And yet now we're going to be moving into like $146 territory, higher or lower. Again, it's where I say, put on your big boy pants, get ready to rumble. Volatility is here. And again, it does appear that the onslaught of volatility has just begun. You cannot be shocked nor surprised to see like VIX clear up into the 40 handle. You realize you got to start opening up a 15-year chart and you can count pretty much on one hand the number of times VIX has been in the 40 handle. Don't be surprised to see it this next week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.